Every single Canadian investing in US stocks is losing money to a tax most people don't even know exists. It's called withholding tax. And if you're holding American stocks in the wrong account, you're silently bleeding 15% of every dividend. That money goes straight to the IRS, and in many cases, you will never get it back. Here's what makes this worse. Your Canadian brokerage won't warn you. Your bank advisor probably doesn't understand it. And most financial content online is either American, which doesn't apply to us, or surface level Canadian content that barely scratches the surface. Today, I'm giving you the complete no BS guide to US withholding tax for Canadian investors. By the end of this video, you'll know exactly how withholding tax works and which accounts protect you. You'll understand the specific ETF structures that save or cost you thousands of dollars, and the precise strategy to minimize this tax completely legally. This is a Canadian Finance Bible on US investing. Let's get into it. Section 1. The 15% tax you didn't know you were paying. Let's start with the basics, because most Canadians have absolutely no idea this even exists. When a US company pays a dividend, the IRS automatically withholds a portion of that dividend before it reaches foreign investors. For Canadians, that withholding rate is 15%. This isn't optional. It happens automatically at the source before the money even leaves the United States. Let me give you a real example. If Apple pays a $1 dividend, you receive 85 cents. The other 15 cents? Gone to the US government. You'll never see it again. Now, here's where it gets interesting. Canada and the United States have a tax treaty. This treaty reduces the withholding rates from 30%, which is what most foreign investors pay, down to 15% for Canadians. But the treaty includes something even more powerful, a special provision for retirement accounts. And this is where your account choice becomes absolutely critical. The tax treaty says that US dividends paid into a qualifying retirement account are completely exempt from withholding tax. The RRSP qualifies for this exemption, the TFSA does not. Let me repeat that because it's the single most important thing in this entire video. RRSP equals 0% withholding, TFSA equals 15% withholding. If you hold US dividend stocks in your RRSP, you pay zero withholding tax. Zero. If you hold the exact same stocks in your TFSA, you lose 15% of every single dividend to the IRS. Forever. And here's the painful part. You cannot claim this money back. Not as a foreign tax credit, not on your tax return, not ever. This single decision, which account you use, can cost or save you tens of thousands of dollars over your investing lifetime. Let me show you the actual math. Say you invest $100,000 in a US stock portfolio yielding 2% annually. That's $2,000 per year in dividends. In an RRSP, you keep the full $2,000. Every single penny stays in your account. In a TFSA, you keep only $1,700. The IRS takes $300 every single year. $300 per year might not sound catastrophic, but let's see what happens over 30 years. Assuming reinvestment and 7% average growth, that 15% drag compounds to a difference of approximately $47,000. $47,000 lost to a tax you can completely and legally avoid by simply using the right account. Section 2. The account placement strategy. RRSP versus TFSA versus non-registered. Now that you understand the basics, let's build a complete strategy, because this isn't just about US stocks. It's about optimizing your entire investment portfolio across all your accounts. I call this framework asset location, not to be confused with asset allocation. Asset allocation is what you own. Asset location is where you own it. Both matter enormously for your long-term wealth. Let's break down each account type starting with the RRSP, your most powerful tool for US investments. Your RRSP is the only Canadian account that's exempt from US withholding tax under the treaty. This makes it the ideal home for US dividend-paying stocks like Johnson & Johnson, Coca-Cola, and Procter & Gamble. It's also perfect for US-listed ETFs that hold American stocks, funds like VTI, VOO, and SCHD. and especially US REITs, which have high dividend yields and would face massive tax drag anywhere else. The math is crystal clear. Any US investment with a meaningful dividend yield belongs in your RRSP first. But there's an important nuance. RRSP contribution room is limited and precious, so you need to prioritize what goes in. Here's my priority ranking for RRSP space. Priority 1, US REITs and high-yield US stocks with dividend yields above 5%. These benefit the most. Priority 2, US dividend ETFs like SCHD and VYM that focus on dividend-paying companies. Priority 3, US broad market ETFs like VTI and VOO. Good choice, but lower dividend yield means less tax savings. Priority 4, US growth stocks with low or no dividends, only if you have space remaining after higher priorities. Now let's talk about the TFSA, and I need to be very clear about its limitations with US investments. Your TFSA does not qualify for treaty protection. Any US dividends are subject to 15% withholding, permanently lost. This makes the TFSA a poor choice for US dividend investments, but it's still an incredibly powerful account for other purposes. The TFSA's superpower is completely tax-free growth. No tax on capital gains, ever. So optimize for growth, not dividends. Ideal TFSA holdings include Canadian stocks, which have no withholding issues and benefit from the dividend tax credit, Canadian-listed ETFs holding Canadian stocks, and US growth stocks with zero or minimal dividends. Think early-stage growth companies, high capital gains potential, minimal dividend yield. That's TFSA territory. Now, let's cover non-registered or taxable accounts. These are more nuanced than most people realize. Non-registered accounts also face 15% US withholding tax, but unlike the TFSA, you can claim a foreign tax credit. This credit offsets the Canadian tax you'd owe on those same dividends, so you're not double taxed. The net effect is roughly neutral. You're not losing money like in a TFSA, but you're not avoiding tax either like in an RRSP. Here's the complete comparison. RRSP, 0% withholding, best outcome. TFSA, 15%, cannot claim back, worst outcome. Non-registered, 15% withholding, but claimable as credit, neutral outcome. The ranking for US dividends is crystal clear. Section 3. The ETF structure problem. This is where it gets complex and where the real money is made or lost. When you buy an ETF, you're not just buying stocks, you're buying a structure, and that structure determines how many layers of tax you face. There are three main ways Canadians can access US stocks through ETFs. Each has completely different tax implications. Structure 1. US-listed ETFs like VTI, VOO, and QQQ. You buy these directly on American exchanges. When you buy a US-listed ETF directly, you face only one level of withholding tax. This is the most tax-efficient structure. In your RRSP, this means 0% withholding. You keep every penny of dividends. This is the gold standard. Structure 2. Canadian-listed ETFs that hold US stocks directly, like Vanguard's VUN or iShares XUU. These ETFs face 15% US withholding at the fund level, before distributions ever reach you. This is critical. And here's what most Canadians don't understand. This happens regardless of which account you hold the Canadian ETF in. Even if you hold VUN in your RRSP, the fund itself pays 15% withholding because the fund is Canadian, not you. Many Canadians assume holding a Canadian ETF in their RRSP protects them. It does not. The 15% is already gone. To get true RRSP protection, you must hold US-listed ETFs directly. VTI in RRSP beats VUN in RRSP every single time. Structure 3. Canadian-listed ETFs that hold other US ETFs. This creates two layers of withholding, the worst possible outcome. Thankfully, most major Canadian ETFs have moved away from this wrapper structure, but some still exist. Always check your holdings.
Section 4. The W-8 Ben Form. What it is and why you absolutely need it on file. The W-8 Ben is a U.S. tax form that certifies you're a foreign investor entitled to treaty benefits. Without it, disaster. Without a valid W-8 Ben on file, the IRS assumes you're American and withholds 30% instead of 15%. The form is valid for 3 years, and your brokerage should prompt renewal, but verify it yourself. Don't assume. Section 5. Your complete action plan. Here's exactly what to do with this information starting today. Step 1. Audit your current holdings. Open your brokerage accounts right now and identify where your U.S. investments sit. Are you holding U.S. dividend stocks in your TFSA? That's a red flag. Those need to move to RRSP when possible. Step 2. Prioritize your RRSP space for U.S. dividend investments. Follow the priority ranking I showed you earlier. Steps 3. Consider U.S.-listed ETFs if you have significant U.S. exposure. The tax savings compound over decades. Step 4. Verify your W-8 Ben status. Log into your brokerage and confirm it's current and valid. Step 5. Don't sell investments in taxable accounts just to relocate them. Selling triggers capital gains tax. Instead, redirect new contributions to optimal accounts and rebalance gradually over time with fresh money. Let's quantify the total impact with a realistic example. $200,000 portfolio, 50% U.S. stocks, 30-year horizon. Doing this right versus doing this wrong creates a difference of approximately $94,000. $94,000. That's the cost of not understanding this single tax concept. And now you understand it. Let's recap what you now know. U.S. withholding tax is 15% on dividends for Canadians, 30% without W-8 Ben. RRSPs are exempt from this tax under the Canada-U.S. Treaty. TFSAs are not exempt and withholding is permanent. ETF structure matters enormously. U.S.-listed in RRSP is the gold standard for tax efficiency. Canadian ETFs face fund-level withholding regardless of your account, and your W-8-BEN must always be current. This is the Canadian Finance Bible. One video at a time, we're building the definitive resource for Canadian investors. If this video saved you money or will save you money, hit subscribe and share it with another Canadian investor who needs to see this. Drop a comment below telling me which account your U.S. investments are currently in. I read every single one. I'll see you in the next video where we dive even deeper into Canadian investing strategies. I'm Jay, this is the Maple Finance.